A lot of people think the silver trade died the day the chart broke. That is the easy story. Silver rips to insane highs. Momentum traders pile in. The market gets euphoric. Then it cracks. Hard. And everybody decides the trade is over. That is not what happened. What actually happened is worse. The silver trade did not die. It got more dangerous. Because now you have a market that still has the same structural ingredients that made the move possible in the first place. Tight physical conditions, recurring supply deficits, volatile investor flows, and a thin enough market structure to turn stress into chaos. But now it is layered with fresh psychological damage. Reuters reported silver hit an all-time high of 121.6 on January 29, 2026, then dropped more than 25% in a single day, the biggest one-day fall in LSEG data going back to 1982. Reuters also reported that 2026 is still expected to be the sixth straight annual silver deficit. That is the setup, not a dead market. A wounded market. And wounded markets are often more dangerous than euphoric ones. Because euphoric markets are obvious. You can see the mania. You can smell it. Everybody is posting price targets. Everybody is talking in absolutes. And even people who do not understand the trade suddenly feel like experts. Wounded markets are different. Wounded markets still have a real underlying story, but now they also have trauma. People remember the pain. They hesitate. They size wrong. They get too early, too late, too confident, or too cynical. They stop reacting to fundamentals cleanly because the recent memory of violence distorts every decision. That is silver right now. And if you do not understand that, you do not understand why this trade may actually be more dangerous after the crash than it was during the run. Here is the first thing to get straight. The silver trade was never just about price. It was about structure. It was about a market with genuine physical tightness, repeated supply deficits, and strong enough investment demand to periodically collide with a relatively small, highly emotional, highly unstable trading ecosystem. Reuters reported in February that global silver demand in 2026 is expected to stay broadly steady. Physical investment demand is expected to rise 20% to 227 million ounces. And the market is still projected to run a 67 million ounce deficit even with modest supply growth. That matters because it means the underlying pressure did not vanish just because the chart embarrassed people. That is the mistake casual observers keep making. They see the crash and assume the thesis must have been fake, wrong. The price move may have been exaggerated. The positioning may have been crowded. The timing may have been terrible. But that does not mean the structure underneath the move disappeared. In fact, Reuters reported that silver's surge above $100 in January was driven by retail investor and momentum-driven buying added to a prolonged spell of tightness in physical markets. Read that carefully. Not just hype, not just retail, not just a squeeze story. Tightness in physical markets was already part of the setup. That is why the trade did not die. The ingredients are still here. But the reason it got more dangerous is that the market learned something, and so did the participants. The market learned it is capable of absurd upside moves once financial demand rediscovers physical tightness all at once. Participants learned it is also capable of catastrophic downside moves once stops, leverage, and panic selling take over. That combination is toxic, because now every rally can trigger fear of missing out and fear of getting trapped at the same time. That is not a calmer market. That is a more unstable one. Let me make this concrete. Imagine a bridge that everyone already suspected was under strain, but traffic kept flowing, so most people ignored the warning signs. Then one day, a huge section cracks. The bridge does not fully collapse, but suddenly nobody sees it the same way. Some drivers avoid it entirely. Some race across it because they think closures are coming. Some engineers start taking the old warnings more seriously. Some politicians insist everything is fine. The structure is still there, but behavior around the structure changes radically. That is silver after the blow-off. The bridge did not disappear. Confidence in the bridge changed. And once confidence changes, price moves get weirder, not cleaner. This is where the real danger starts. Because silver is one of those rare markets where the physical world and the financial world can spend long stretches disagreeing violently. The physical world says supply is still strained. Deficits keep appearing and enough demand remains to prevent real comfort. The financial world says liquidity, momentum, Margin, macro fear, and technical selling can overwhelm anything in the short run. Both can be true at the same time. Reuters showed exactly that. In January, silver surged on tight physical conditions and heavy investor demand. By early February, the same market had turned into a liquidation event, with technical selling and stop losses creating a snowball effect. That is why this trade is more dangerous now. Before the blow-off, people were underestimating the upside instability. After the crash, many are underestimating the fact that instability itself is now part of the market's identity, and instability cuts both ways. Another reason this trade got more dangerous is that the supply side still is not responsive enough to make the market comfortably loose. Reuters reported total silver supply in 2026 is expected to rise only 1.5% to around 1.05 billion ounces, with mine production up just 1% and recycling up 7%. Helpful, yes? Enough to erase the deficit? No. That is not a market that healed. That is a market that bought time. And bought time gets mistaken for stability all the time, until demand comes back harder than expected, until physical investment accelerates again, until some new macro shock makes silver attractive as both a hard asset and a momentum trade, until delivery stress matters more than people thought. That is what people do not understand about structurally tight markets. They do not need to be in constant visible crisis to be dangerous. They just need to be tight enough that the new wave of attention can do disproportionate damage, and silver is exactly that kind of market. There is also a psychological layer here that makes the post-crash setup even more treacherous. The first version of the trade was driven partly by belief. Belief in the shortage, belief in the squeeze, belief in the breakout, belief in the idea that silver had finally woken up. Now, that belief is fractured. Some traders are still true believers. Some are shell-shocked. Some are waiting for vindication. Some will fade every rally because the last one ended so badly. Some will chase every rally because they missed the insane upside move the first time. That mix creates a much sloppier battlefield. And sloppy battlefields are dangerous because price stops moving purely on fundamentals and starts moving through memory, regret, and positioning reflexes. That is what silver looks like now. Not a clean bull market, not a dead story, a damaged story with live structural tension underneath it. And that is often the hardest kind of market to trade because the fundamental thesis can still be mostly intact while the path becomes dramatically less forgiving. Think about the asymmetry here. If the deficit story stays real, and Reuters says it does, down, then every renewed wave of investor demand has the potential to hit a market that still does not have a comfortable supply cushion. But if that demand gets ahead of itself again, the market now has a proven history of punishing excess with brutal speed. That means every participant now has to ask two questions at once. What if the silver trade is still right? And what if the path to being right is violent enough to destroy me first? That is a much more dangerous trade than the simpler version people thought they were in before. Before, many thought silver was just an underrated bull market. Now it is clearly something else. Now it is a structurally stressed market with a known capacity for mania and a known capacity for collapse. That is a different animal, and it changes what series people should watch. Not just spot price, not just hype. Watch the physical investment trend. Reuters says it is expected to rise sharply in 2026. Watch supply response. Reuters says it is improving only modestly. Watch whether deficits actually narrow meaningfully, or whether the market just keeps limping through them. Watch whether the next rally is driven by fresh structural tightening, fresh investment demand, or just reflexive momentum, because those are not the same thing. And in a market like silver, mistaking one for the other is how people get carried out. So what should a serious viewer take from this? First, the silver trade did not die with the crash. Reuters still describes a market with tight physical conditions and another projected annual deficit. Second, the January-February collapse made the trade more dangerous because it proved silver can deliver both spectacular upside and historic downside in extremely short windows. Third, supply still is not loose enough to make the market comfortable. Modest supply growth is not the same thing as resolved structural strain. And fourth, the post-crash silver market is now driven by a more unstable mix of real physical tightness, investor demand, damaged psychology, and volatility memory. That is the real thesis here. The silver trade did not die. It got more dangerous because the same supply deficits, physical tightness, and investment sensitivity that helped create the blow-off are still there. But now they live inside a market that has already shown everyone exactly how violent it can be. And once a market shows you that, the next trade is never the same as the last one.